Welcome to the weekend. It is here. Now, before we head out into the weekend and have a little fun, hopefully all of you have some fun things planned. Before we head out for the weekend, we need to help you take that next step. Just because the weekend's in front of us doesn't mean we have to ignore everything that's beyond that. We can still take some lessons from today's market moves, economic data, and I can still give you my perspective. Developed over 20 plus years of investment experience. Now I'm Justin Klein, and our goal each and every weekday is to answer your finance and investment questions and bring you relevant data and perspective that can help you make good investment decisions, good money decisions in general. So that's the goal for this hour. And we're going to talk about the market performance as well as run down some show topics. But right after we answer our first caller question now.
I was calling about Unum Group, ticker symbol UNM. I own a small amount. Wanted to know if it's worth buying more or just selling. Just seeing what you guys think. Thanks.
All right, looking at Unum Group, about a $9 billion market cap. And what they do is they provide group and individual income protection insurance, basically disability insurance here in the US, the UK, Poland, and many other countries as well. It is the largest domestic disability insurer. Okay. And with people having jobs, that helps because that means they have money to pay premiums and they have incomes to protect. So the current jobs market being relatively tight, that's a good thing. And their business has continued to grow. They made $3.88 in 2016. 2022, $6.33. And last year, once they report fourth quarter earnings, should make about $7.72. And $7.81 is expected to be earned this year. So I like that consistent growth. And if you go based on this year's expected earnings, you're talking about a 6 multiple. It's pretty cheap. That's pretty cheap. Now, there are some caveats here. The cash flow is not nearly as strong as those that earnings would lead on, but it is good. It is solid. And the dividend 3% is solid. I see no issues with it. It's been buying back shares, so I like that. So part of that EPS growth is shrinking of the amount of shares outstanding. So that's where a lot of that EPS growth is coming from. But overall, I like it. I like the insurance industry. It has had a pullback recently. I see no reason to sell it. In fact, I wouldn't be against buying more at this time. That was Unum Group. UNM is the symbol. Now, we have a lot of ground to cover over the next 40 minutes, and my main focus point concerns this question. What are Wide-Moat stocks? Well, Wide-Moat stocks typically carry sound balance sheets, have high profitability, but there are other attributes as well. What determines a Wide-Moat stock? So we'll take a look at the economic moat methodology, stock sector analysis, and more. We also have other topics. One is in regards to consumer sentiment. It's bouncing back. We're going to talk about why that might be. Also, corporate credit markets. They're pricing in a pretty rosy future when it comes to defaults. And we're going to talk about whether that is justified. And then lastly, geopolitics. We have Davos, the Davos meeting going on right now. And a lot of the discussion is around geopolitics and how that affects markets and economies. So how much should geopolitics play in the way you think about your portfolios? So that's what's on the docket for me. And for you, we have your voicemail questions. One is on where to invest, and the other is BSTZ, which is the BlackRock Science and Technology Fund. Or trust, excuse me. And since it's Friday, I'll share a brief highlight of the newest KPP Premium newsletter. Now let's take a look at the market performance for today. It was OPEX week, and I said likely means positive markets, at least until Option X, and that is today. And that typically drives positive flows in markets, especially in the names that have the most action in the options market, and those are the big cap names. And that's what you saw. Large cap growth up 1.52%. The broad market was up about 1.25%. Small caps up about a little less than 1%. So traded at all-time highs, and not a shock to see. We'll see if we can hold these. I think that's the big question. Can we hold the gains through the end of the month? And remember, we have the Fed meeting at the end of the month as well. Will this market strength give them continued pause and get the market to push back the expectations for Fed rate cuts till later in the year? Because right now, there's priced in a 97% chance of a pause on the 31st. Then the next Fed meeting is mid to late March. And that is now down to about a 50% chance of a cut by then. A week ago, it was 77%. So this market strength is certainly, and the economic data, which remains fine, that is already pushing off a little bit the expectations of a rate cut. And I said this going into the year that I think that was the biggest risk to the bond market, at least, was that, the Fed promised 3 cuts and the market priced in 6. And already the market's starting to price out a couple of those cuts. Because as we go to December, the median expectation is now about 5 rate cuts, whereas going into the year, we were about 6. So they've priced out about 1. And we'll get more news on that to close the month. But yeah, I don't want to say I write off Option X week. There's a lot of market positioning kind of behind the scenes that doesn't really give you a good sense of the true trends in the market. So I'll be watching to see what kind of trends emerge next week. And that's what I'll be watching. Now, as we go into a break, let me remind you to check out our new InvestTalk Classroom series. Our latest episode 16, is titled The Residential Housing Market in 2024. Luke and I talk about the market dynamics in housing, as well as I offer my perspective on lifestyle goals when you select a home. For example, should you always be worried about turning a profit on your home? Simple answer is no. It's not the main priority. Valuations are high within the market and supply is low. So those are some additional current market dynamics that we discuss in our latest episode of the InvestTalk Classroom series. So just head over to YouTube and search InvestTalk Classroom. Now the phone lines are open, waiting for your questions at 888-99-CHART.
Every investor is working to build a secure financial future.
Would this be an opportune time to get into annuities?
Everyone's situation is different.
Get your thoughts on CRM, Salesforce.
And so are their questions.
And I was just calling for your assessment of Blackstone Incorporated.
To get your take on QE.
Ticker symbol LECO.
Just wanted to get your opinion on JP Morgan.
InvestTalk hosts Justin Klein.
I'm okay paying a fair price for a very good business.
Steve Peasley.
It's a very well-run company.
And now Luke Guerrero.
EBITDA growth is significantly higher than its competitors.
Are ready to provide their unbiased answers. Each podcast is unique, and you set the agenda.
I will.
Hey, hi, Steve.
24/7, rain or shine, InvestTalk is made better by the power of you. Call 888-99-CHART. Your objective is to work hard, plan well, and achieve financial freedom, right? You're in luck, because Justin Klein is here now, ready to take your finance and investment questions. Call 888-99-CHART.
Let's go talk to Don. He is in Orinda, California, and he wants to talk about McDonald's.
Yes, I own 75 shares of McDonald's. I received an email from them saying, "Hey, we're trying to get everyone to come up to even lots, 100 shares. So we're giving you two options: one, either buy more shares, or two, sell your shares." And it's not a requirement; it's just one of those things they're asking people to do. I've never seen this before.
I've never seen that either. Are you sure that's coming from McDonald's, or is this coming from your broker?
Yes. No. Well, okay, I take it back. It could be coming from the broker. E-Trade's the broker, so whoever purchased them is making some changes. I just assumed that I'd never seen that before, though. So that was very strange to me. So, okay, I see E-Trade wanting to clean it up, so...
it could be.
Yeah,
I see no reason why McDonald's would do that. In fact, McDonald's, I don't think, has shareholder emails. So it would probably be coming from your broker. And there's probably some reason for it behind the scenes. I don't know what that would be. But
one more thing on this.
Yeah.
One more thing is that they, if I saw it correctly, I should have had it open. But it was... For this, they'll charge you $5 a share, and it goes into this certain group, and the people buying will pull from this group, the people selling will pull from this group. It's really bizarre.
So I'm looking this up here. This looks like because Morgan Stanley bought E-Trade. This has something to do with the transition to Morgan Stanley. And do you have fractional shares of this?
No, I do not. I have 75. And they want me up to 100 or gone.
That's so weird. I don't know. I mean, McDonald's, obviously a large blue chip name. Right now, I see it as about fairly valued. It's it's ran up pretty nicely from $250 or so all the way to $300 in a rather short period of time. So it's a bit overbought near term. Do you have a date that you're supposed to be do this by?
I'm going to say it was February 1st.
Okay. And are you married to E-Trade or now Morgan Stanley? Are you okay moving? It's another option.
Actually, no, I'm not. I have a lot of stuff in there.
Okay.
But what would you suggest?
Well, I think any of the large brokers is good. We use Schwab. Fidelity is great too. Those are kind of the two other large ones that probably make the most sense if you were to move it. And they don't require you to buy 100 shares or sell it all. So if this is something they're going to continue to demand from you, which seems odd to me, I'd have to do some research on why they would even do this.
It is a request. It is not a demand. It is a request.
It's a request. Maybe they're just trying to get you to put more money on the platform. I'm not sure. So if it's a request, then I would just ignore it because right now it wouldn't be, I think, a great time to be buying McDonald's shares. It's not a bad time, but it probably not a great time. It's not a great time either.
Okay, then I'll hold them and see what happens. Thank you very much.
Yeah, no problem. Yeah, it would be neutral on McDonald's. Now we're going to a quick break. Please remember that you can call anytime and leave your questions on the InvestTalk voice bank. And if you're listening via our live stream or on AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART.
Each day, InvestTalk listeners submit their finance and investment questions via phone or email. Would you like your question to be put near the top of the list? Just take a minute or two to leave a review and rating for InvestTalk at iTunes. And be sure to include a brief question with your iTunes review comments.
Now, my main focus concerns this question. What are wide-moat stocks? What are wide-moat stocks? And put simply, Wide-Moat stocks have good balance sheets, and most importantly, a strong competitive advantage. Now, there's different levels to this of competitive advantages. There's minor competitive advantages and major ones and medium ones, right? It's all shades of gray here, okay? So understand that first, is that not all companies can be treated exactly the same, and all have varying risks to their competitive advantages as well, depending on the source of that competitive advantage. Now, over the long term, companies that do have wide economic moats, and think of a moat like a castle, that's why they call it a moat, saying, here's our business, we have this moat that's protecting us from competitors coming in and stealing our high economic profit, our high profitability. And that's the first indicator that a company has a good economic moat or high competitive advantage, is that they have strong and consistent profitability. It allows them to charge above average prices for their products and services. And this allows them to successfully fend off competitors for decades. Now, they can be things that create high switching costs. Others have strong brand identities. Or they might possess economic scale. Now, what's a high switching cost? Apple has a wide economic moat due to high switching costs. And that is, if you've been using an iPhone for a long period of time, you have a lot of pictures and data, and that ecosystem kind of keeps you from switching. And the switching cost doesn't always have to be money. It's not, oh, I have to pay money to get it. A lot of it is what people are used to, and their unwillingness to, learn a new system. So that's one type of switching cost. Another are strong brands. Think of Coke or McDonald's. Then there's also intangible assets. So think of IP, but a technology that this happens in pharma, for example. They have patents on certain drugs. Now, those patents come off, and there are definitely a lot of pharma companies dealing with that right now, patent cliffs. And so those intangible assets have a certain life to them. And that prevents other companies from coming in and duplicating their products. Then there's network effects. You see this a lot in social media. You could build the coolest, most amazing platform, but if your friends and other people aren't on it that you want it to be, then you're not seeing enough being shared, and it doesn't create that ecosystem that keeps you there. And that's one of the hardest things to create, is that size advantage. So network effects are a big part of that. And then there's cost advantage. This happens in commodity companies, for example. They might be the lowest cost producer because the mine they own is just abundant and easy to get the product out of the ground compared to others in the world. That's one example. But there are many. So just cost advantage in general. And that can be due to scale. And that's another one, efficiencies of scale. Think of a Walmart or a Costco. They have bargaining power with the companies that produce the products that sell into their stores because they have such heft. They have such large revenue, and they can promise that they are bringing in X number of consumers and driving X number of sales, and therefore they're able to negotiate a much lower price and pass that on to consumers, and thus keep those consumers going there because they can't get those lower prices elsewhere. So this is the concept of what an economic moat is. And so when you're investing in companies, you should ask yourself, what advantage do they have? Are they a price taker? Or can they impose their price on the market because of these competitive advantages? And long term, not 6 months, a year, long term, companies with a competitive advantage, with an economic moat, tend to outperform. And when you combine that with trying to find the ones that are trading at fair or cheap prices, you can have a very strong strategy that can outperform over the long term. Now we're heading into a break. I'm Justin Klein. I'm ready to take your calls now at 888-99-CHART.
Every investor is working to build a secure financial future. How they get there and when they get there, that depends on many variables. The more you learn about how the market works, the better your chances. So don't forget to call InvestTalk, 888-99-CHART.
For my focus point, I will discuss this topic: mean reversion and a historical analysis of asset class performance. Investing is a dance of numbers, trends, and predictions, and it's important to understand the concept of mean reversion when it comes to certain asset class performance. That story is for Monday, but now let's play another listener question from 888-99-CHART.
Hi, Steve, Luke, and Justin. I'm a recent listener to the show, and I really like the show. I do appreciate your unbiased feedback on the show. I came to know about Steve from one of the announcements, and my prayers for his speedy recovery, and he gets well soon. My question for today, I'm looking at this BMEZ and BSTZ. Those are BlackRock closed-ended funds, and I'm not sure whether those investments I compare with respect to other funds and ETFs. Currently, they offer good yield on a monthly basis, and also they are at quite a discount. I'm looking at investing them into long-term retirement portfolio for 5 to 10 years. I don't know how does it compare with respect to its term-based closed-ended funds. So I really appreciate your thoughts on those kind of investment to add in your retirement account. Thank you, and I'll be listening to your show.
All right, looking at BSTZ and BMEZ. This is the BlackRock Science and Technology closed-end fund, trading at a discount. Let me look at the portfolio here. I don't like to just look at the title because the title, especially here, doesn't tell you a whole lot. Let's see, 68% equity, 33% other. Okay, owns NVIDIA as his top holding, Synopsys, Tesla, Palo Alto Networks, and Jabal Circuit. Top 5 holdings. So this is a tech-focused fund. 78% is in technology. I'm not getting a whole lot when it comes to the chart. It doesn't look like its performance has been very good. It looks like it was flat for most of last year. I know it's trading at a discount to NAV, but especially right now, I don't see any reason to get into this name. Now, BMEZ is the health sciences, more biotech, and this is kind of the same thing. You know, I don't see closed-end funds as a bad thing overall. I mean, these are not bad investment vehicles in general. Just like ETFs aren't bad investment vehicles in general. Some are good and some are not good. These ones don't seem to be very good. And the expense ratios are high. BMEZ is a 1.32% expense ratio. BSTZ is 1.33. That's just way too high for what you're getting here. So I'm passing on both of these, but don't think that I hate all closed-end funds. Now it's Friday, and I generally make time to fit in a quick rundown of some key benchmark numbers. The 2-year Treasury yield up to 4.41%. That's up from 4.16 last week. So it shows you, as I said at the top of the show, market pricing out a full rate cut pretty much this entire week due to strong economic numbers, strong equity markets, etc. And that's reflected in the 2-year. The 10-year did move up, but not quite as much, from 3.96 to 4.16. So about a 20 basis point move there versus 25 basis points on the 2-year. Gold priced at $2,026 per ounce, down a little bit from $2,047 last week. That's typical when you see rates move up in any given week. Silver was down as well, $22.60 an ounce from $23.18. Oil, that also moved down a bit, $73.58 a barrel from nearly $76 last week. Gasoline prices, they ticked up for the first time in a while by a penny. National average went from 307 to 308. Here in California, we saw actually improvement. $4.51 from $4.59 last week. Illinois, average was $3.24 per gallon. Now, the KAPP Premium Newsletter was finished today, and it will be distributed to subscribers tomorrow, and I have a preview. In the market conditions section, we explain that stocks rallied early today with the S&P 500 up 0.3%, inching closer to all-time closing high set in January of 2022. Largely driven by significant gains in the technology sector as the S&P 500 and NASDAQ erased their 2024 losses. In contrast to the buoyant stock market, the housing sector saw a downturn in 2023. Sales of previously owned homes in 2023 plummeted to their lowest level since 1995, a 19% decline year over year. So those numbers were released. High mortgage rates ranging from 6 to 8% coupled with the elevated home prices have rendered home buying unaffordable for many. On a broader note, Americans are showing increased optimism about the economy. There's a lot more commentary, details in the newsletter. We also touch on some stock ideas, things to keep on your watch list. The company that produces semiconductors for wireless handsets and other devices that are used to enable wireless connectivity. With the P at 12, it is attractively priced, and earnings growth should start to rebound in the second half of the year. We also look at a company that sells automotive parts and industrial components. Sells car and truck parts to commercial and retail customers through roughly 9,800 stores worldwide. Has a 2.7% dividend rate and trading at about a 15 times P multiple. We name names in the newsletter. Subscribers receive the full edition every Saturday to their email box. We also have a portfolio management section as well as Consumer Watch. To learn more, just head over to InvestTalk.com to subscribe. Now let's touch a bit on that consumer sentiment, because that was really the interesting news of the week. That consumer sentiment has surged 29% since November, the biggest 2-month gain since 1991. And this is mainly driven by cooling inflation and signals by the Fed that rate increases are behind us. And you combine that with labor market that remains not amazing but solid, and the fact that people still have money in the bank means consumers feel a little more confident to spend. Consumer sentiment leapt 13% in the first half of January from December as well. And it was broad-based across different ages, incomes, education, and geography. Now, despite the recent gains, the measure is still about 20% lower than where we were pre-pandemic, and more consistent with an economy that's coming out of a recession as opposed to one that still may be headed into one. Now, one of the big reasons for the rebound and the change in inflation expectations is a drop in gasoline prices. And that helps at the margins. And the margins are typically where most consumers spend, which drives 2/3 of the U.S. economy. The share of consumers in December who expected to be financially better off 1 year from now hit its highest levels since June of 2021. Now, we're also in an election year, so that's going to play a big factor in probably how the election plays out. The old saying, it's the economy's stupid. And obviously, those that are on the right, hammering President Biden on the economy. But those that make $100,000 or more, this is where the big sentiment shift is starting to happen. And those tend to be people more on the left. But right now, the president is losing the argument, despite steady improvements in the job market and on inflation. And that's what will be, I think, the big factor going into the election is, will inflation continue to ebb, or will we get a resurgence? Will mortgage rates continue to head lower, or will we head back to 7-8%? Will the S&P continue to march higher, or will we get a major setback? Consumer expectations for inflation a year from now dropped to 2.9%, the lowest level since December of 2020. That's down from 4.5% in November. So that's a big change in sentiment in just a couple months on inflation. The Fannie Mae index of home buying sentiment also jumped 10% in December. So that is getting people a little more optimistic. And then the media coverage of the economy is also getting more upbeat. And that's according to the Brookings Institute. So it's going to be very interesting to see what risks evolve, or how the risks evolve. We know there are risks. Some will be ones that we know are out there that continue to intensify, maybe geopolitical risks, for example. And others probably are not on the top of mind for many and will suddenly come out of nowhere. So 9-10 months, that's a lot of time, but it'll be interesting to see how the sentiment around the economy evolves as we go into the fall. Now it's Friday, the weekend is almost here, but for now, let's play another caller question from 888-99-CHART.
Hi, Justin. I know you and Steve are not too fond of cyclical stocks, specifically the auto industry, but I wanted to ask your thoughts on Honda, ticker symbol HMC. It is now looking like it's trying to expand into the EV market. And from what I see on Fidelity's info, it looks like it's a good business. I don't own it. Looking into perhaps expanding into it while I cut down on some of my other holdings. So just wanted your thoughts. Thank you.
Well, let me start by saying I'm not a fan of cyclical stocks. I think cyclical stocks are usually fine because the economy does tend to grow over the long term. Now, the business of cyclical stocks does tend to ebb and flow. But I'm more worried about, as our main focus point touched on, is their economic moat, their competitive advantages. And you can still have a great business that is cyclical, that would love to own long term. Yeah, you'll get some gyrations in the short term due to economic changes, but over the long term, that economic moat will endure and create positive economic profit for shareholders. So don't think that we don't like cyclical stocks. We like good companies. Some are cyclical, some are not. In fact, most companies are cyclical. So if you weeded out all of them, you'd be hard-pressed to create a solid portfolio. Now, Honda Motors is a very good car manufacturer when it comes to profitability, cash flow. Now, I don't love the car industry. It's just a very competitive market, high cost of capital, and high fixed costs. We have these huge manufacturing facilities all over the world, and margins tend to be very slim. And if you look at Honda Motors, look at the stock chart. It's pretty much gone nowhere in nearly 20 years. It hit the $30 level in 2006, and it's basically been trading in a range between 22 and 36 since then. Now it's at 32. And I think that's all you really need to know. Return on equity is 7.5%. Its 5-year average is 6.5%. That's not very high. Its operating margin is 5.3%. Its long-term average is right around 5%. So that's my issue here, is it one of the better car manufacturers? Sure, it is. But it's been stuck in neutral, pun intended, for nearly 20 years. Yeah, you're getting the dividend, which is 3%, but I mean, that's almost a return of cash over the last 20 years. And you have volatility and risk. So I just don't see an exciting name here. I just look at car companies in general. I could bring up almost any of them. GM, Ford. And it's just a very difficult business to operate. The only ones that you made money on are the EV companies, and basically that's on hype. Let's look at Lucid. That continues to plumb to new lows. And Tesla's starting to roll over as well. So, yeah, I don't mind cyclical names. I just don't like the car business. It's a very difficult business. Now, let me remind you that here on InvestTalk, we operate with the same philosophy as we do at our company KPP Financial, which is independent thinking and shared success. We offer unbiased guidance both on and off air, and we practice parallel investing, which means we invest right alongside our clients. So if you need help with your portfolio, don't hesitate to reach out to us via our website and set up a free portfolio review assessment. Now we're moving into a break. Phone lines are open at 888-99-CHART. Who wants to talk about Netflix?
Hey, Justin. Thanks for taking my call. I wanted to get your views on Netflix. What would be a good entry point?
Netflix is at a big run from its lows in early 2023. Actually, no, the lows would be late summer 2022. Right around $175 per share. Now it's at $482. And frankly, it's into major resistance right around the 500 level. Our value, you want to know our value? $250. So it's about twice as expensive as it should be. So, it's trading at 6 times sales. Enterprise value to EBITDA is about 23 times looking forward. I just don't see any reason to get in at these prices. It's just way too expensive. It needs to be, like I said, cut in half this price, I'd pick it up. Thanks for the call. Let's talk about the corporate bond market. And, the collective expectations in that market are always interesting. And they ebb and they flow. You get banking crises like you saw in the spring. And that can certainly spook markets. And credit spreads widened out at the fear, and this typically happens when there is fear, of a default cycle. But one reason that we were not that worried about that little scare was because credit spreads barely widened out. And that is typically a good indicator of, how serious the problems in the economy really are. Because remember, the corporate bond market, they tend to be pretty skeptical. Why? Because they're worried about downside risk. When you're owning corporate bonds, your biggest fear is a credit crisis of some type, where the companies enter an economic environment where they have down earnings, down cash flows, and suddenly can't pay back their loans. So corporate bond holders are more cautious, and they tend to quickly price in a default cycle. So they're very on when it comes to trying to prognosticate a recession or an economic downturn. But today, corporate credit pricing is not saying there's any problems on the horizon. Today, spreads are nearing their smallest levels or lowest levels in 20 years. Now, does that mean there aren't opportunities in the corporate credit market? No, there are. But they're a lot less than they were a few months ago or during the banking crisis. In fact, the best thing you could say is that yields are much higher than they have been over the past 30 years. They're substantially higher, mainly because government bond yields are higher. So there's always that spread above government bond yields. So you'll be able to lock in pretty good rates. Right now we're getting 6.5%, 7%, which is not amazing, but it's solid. Especially if inflation does even out around the 3 or 4% level, which is probably where we end up. Not 1 or 2 like we're used to on inflation, but 3 or 4 is probably the base case over the next decade or so. So there's still positive real returns there. And that's ultimately what most credit bond investors are looking for. But it's always interesting to watch how that market is pricing in an economic shift. And so far, they're not pricing in much of any. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this program be considered an offer to buy or sell security. Because such advice is rendered solely on an individual basis and at times will require that the investor review a prospectus before investing. InvestTalk is a copyrighted program of Klein, Pavlis, and Peasley Financial, a registered investment advisor firm which retains all rights. For more information regarding KPP's investment advisors, call 1-800-557-5461. Steve Peasley is president, and Justin Klein is chief executive officer of Klein, Pavlis, and Peasley Financial. Thank you for listening, and your comments and questions are welcome on our 24-hour listener line at 888-99-CHART.